Before we continue with the show, a quick word from today's episode partner, UBS. Do you want to grow with your business? Then the UBS Growth Talks may be for you. You will get support from peers and experts in order to take that next big step towards success. And the best thing, it's free of charge. For more information, go to ubs.com/growth-talks.
Value as such is subjective and guided by the individual who looks at the asset.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. Here's your host, Sylvan.
Jürg, very well welcome to the Swisspreneur Show. Thank you so much for joining us today.
Thanks for having me, Sylvan.
You are an executive director at UBS and also the head of the M&A valuation desk at the corporate finance team in Switzerland. And our topic today is company valuation. First off, I want to start with the common misconceptions. So what do people often get wrong about company valuations with a focus on SMEs and startups?
There are a number of misconceptions we come across in our daily interactions with clients. Often we have to educate clients what's the purpose and also the capabilities of evaluation and what can be reflected in evaluation and what not. One has to understand that value as such is subjective and guided by the individual who looks at the asset. What we try to achieve is to form a market consensus and a market estimate of an asset, and that shall represent where demand and supply meets. It's closer to a price estimate than the actual intrinsic value of the company. This can be the same, but has not to be the same. Also, often clients take reference points from large cap companies, from reference transactions where they have incomplete knowledge about and apply them directly to their company. Obviously, this can go wrong, and there are a lot of also pitfalls when applying evaluations where we don't have the full pictures. Then what's also where you have to educate clients is that there is a difference between the value potential and the time value of an asset. This is specifically or most common case with startup companies where they have a business plan which shows one possible scenario of a future outcome. And obviously, if you apply the numbers directly into valuation models, you get to very attractive figures. But obviously, in reality, people look at various scenarios. They have to judge that. Mm-hmm. And therefore, the value potential does not equal the time value, which also reflects alternatives and the risk associated with the execution of the business plan. In addition, there's also the case that people orient themselves at historic prices. If they paid X for an asset, they expect to receive X plus or X minus Y for that asset. And also they look at the incurred cost and effort they spend in building up the company. One example here is with R&D. From an investor's perspective, it's not dependent on if you spent 10 years in developing something or just had a stroke of genius yesterday and arrived at that outcome. For one, the incurred cost and effort would be enormous. For the other one, it could be nothing. At the end of the day, it's what we have today, looking forward, what's relevant, and therefore that can lead to larger discrepancies in value considerations.
Yeah, very interesting perspectives, I think, here to start. I also want to start with the basics. So why should I actually think about a company valuation, or what are the main reasons why I actually should do a company valuation for my own startup, for example?
Main reason, and also the bulk of our commercial service work, is obviously the acquisition or the disposal of an asset, be that a company as a whole or parts of a company. If I buy a company, I first have to make up my mind what's the company worth for me. I have to reflect what I can do with the asset, but I also have to do not want to overpay a certain company. I have to get a judgment on what would the market be willing to pay for that asset that I can put in a competitive offer, which then allows me to acquire a company at a fair value. On the other hand, if I'm preparing myself to sell the company, usually I want to know first what is a realistic, achievable sales price. Is the market timing good? Are my assumptions correct? Is my planning solid and robust? Have I done my homework with the value proposition? Do I have expectation gaps here, which I'd like to know before addressing a huge community of potential investors and then being embarrassed when not fetching the sales price that I intended to achieve.
And, talking about what do I have to have in order before I actually can start the company valuation process? I'm sure there are certain things that are often forgotten.
Mm-hmm. There are two elements to these questions. One is the homework of the company and the company owner. Mm-hmm. And the other is the homework of the person in charge of the valuation. I think with regards to the company owner, there is limited elements that you can do ad hoc to influence the valuation. Obviously, you have to bring all your knowledge and also thoughts about the future of the company in a form which a third party can then obviously draw conclusions from. And this has to be consistent, this has to be transparent, this has to be complete, just to allow a sound judgment on the company. Mm-hmm. But when you arrive as somebody do in the valuation, and we always put ourselves in the shoes of somebody who's going to acquire the company, and then you learn that there are elements missing to the story, that there is no vision for the future, that there is no sound reasoning why these elements are like that, and there are other things done which are inconsistent, then it's difficult to ad hoc come up with a good explanation. So the more you're in the driver's seat of the company, and especially if you see yourself also already in the door out and trying to sell the company, you still have to have a very good and firm vision of the future of the company, because that's gonna influence the most what buyers will think of the company and the investment case.
And then when we actually start with the valuation process, there are different methods how you can actually value your company. So what are the common practices that you also yourself use?
Yep. There are two fundamental approaches. One is valuation and one is pricing. And with valuation, you try to reflect the intrinsic value of the company, defined by its future cash flows, take into account the risk associated with the investment. Also, an asset-based approach would be a fundamental approach, really like to look at what is the company and the bundle of assets generating in future benefits for me. And then we have pricing, where we look at an asset and look just at prices of comparable companies and then draw those conclusions from that. This is more like you going into a supermarket and looking at things on the shelf and see that in Migros a pound of baking powder costs X and in Coop it costs Y, and then you see, is that high or is that low, and you try to triangulate the value in making a bundle of different assessment based on profit, based on sales, based on asset-based numbers. That also gives you a range where the value of that asset should be. In practice, I'm always applying the whole set of instruments that we have at hand. What we want to achieve also from an advice point of view is that we covered all bases when looking at an asset and came up with the most likely conclusion. Mm-hmm. There are always some methodologies which produce results which are relatively high to relatively low, and the quality of a good valuation is to explain why those differences occur and why the figure that we come out with in the end is closer to that and more represented by applying this methodology. Or if you apply that methodology, we do have to make additional adjustments to take into account other qualitative factors. So there's, as mentioned, you have to have the toolkit. You have to look at the situation and apply the tools that make most sense and best reflect the value of the underlying asset.
Is there any difference, any significant difference between valuing an SME and a startup? Or like, do you use the same method there to come up with the value, or do you use different methods?
I think if we look at valuing SMEs, there you do some adjustments with regards to size and liquidity, obviously, because you do not address with an SME the same universe of investors as we do with larger cap companies. But there are rather mechanic and rather transparent ways to account for that. With SMEs, with startup, we open a whole different chapter of the book, because with startups, what I said initially, that the value is subjective, is more true for them than anything else, because as often is the case, the future is pretty much open. It's a dynamic field. You look at one point in the development of the company, and there are a multitude of potential outcomes, being that of the internal development, but also the development of the world around that company, and you can only take that into very limited account. So we usually look there at what's the purpose of the valuation. If you're a startup company, as an owner, the company has to be worth the absolute maximum or the larger figures you can imagine, because you have to also signal to investors that you are so believe in your story and you believe that more than everybody else in the world. Mm-hmm. So to no circumstance, if not forced, you will be able to give up something of your child to an outside investor. So only at a very high price. And obviously then the reality comes in. At a certain point in time, you're forced probably to take on external money to develop the company as intended. And then there's really one is the question of supply and demand. And there's the question also, what's the use of that money? How many investment rounds do you need until exit? It's really a complex discussion where it's even less possible with traditional valuation methodologies to come up with meaningful numbers. They are used as valuable tools for analytics to calculate several value potentials. But these are only very, let's say, soft points where you can, try to make more transparent the underlying investment case and put some figures behind the thoughts, but not really a basis for coming up with a figure which is within a plus minus 10 to 20% area of the final outcome of an investment round.
Right.
Because as mentioned prior, when we do evaluation, we always want to advise clients what's the best under a given set of circumstances. And you can, if there's no restrictions, you can do everything. But obviously, in every situation, you have a multitude of restrictions, and we have to advise them what's the best course of action to take. And what's also from our point of view, where we draw upon a huge experience of transactions that we had a advising role on, also that we have insights from where somebody within corporate finance had exposure to a transaction. We draw from that wealth of experience to try to come up with sensible answers to really complex solutions, and it's never black and white, and figurative in the end. It's often also only one element of a complex transaction framework, which also includes shareholders' agreements, exit rights, so on and so forth.
I would also like to mention and to go into a bit more detail of the different valuation methods that you have at hand. Maybe one of the most common ones, not for SMEs and startups, but for the very large publicly listed companies, is the market capitalization. Mm-hmm. So that's pretty simple, right? There you have the market cap. That is the value of the company.
Well, that is the value. One has to be also there a little bit careful when we talk of value. The market cap is just the figure that stands for a share price, which you can observe on a market, multiplied by the outstanding shares of the company, and that gives you the market capitalization of the equity of the company. But when observing a share price, for example, we have to also consider that we are looking only at one share. Mm-hmm. So you cannot buy the company for the same price as the price of the share. So there you already have an element of a takeover premium, which you then would have to add to that. And obviously, then we can estimate if that market price of the share is also reflecting all the information that is in the market. For example, with very thinly traded companies, for example, on the Bernese Stock Exchange, you don't have liquidity in the trading, which also means that the share price does not have necessarily be the best indicator of the current value of the company. It only reflects a limited amount of information, and not all the information is out there, and the price setting mechanisms are not 100% perfect because of lacking liquidity in that marketplace.
Right. And another method that we researched is the times revenue method. Yeah. What is that and how does it work?
The times revenue, that's, when you look at the fundamental, these are the pricing methodologies. Mm-hmm. Times revenue is a revenue multiple where you try to assess the enterprise value, which is different from the equity value, usually, by expressing them as a multiple of the revenue a company is generating. And this is a very broad measure and a very imprecise measure, because it does not take into account the profitability of the company, which is the most important aspect, but various other elements, obviously. It's really a simplification, but it allows you to compare companies one against the other, and also allows for some judgment on companies which currently do not produce earnings, or where the current earnings situation is not representative for the underlying sustainable earnings generated by the company. We use that as complementary figures mostly. With startups, it's probably more often used. But also there, if we take a revenue multiplier method, then this is always in connection with also an EBITDA or an EBIT multiplier. Then we basically look at the evolution of the company, where we do think where is the EBITDA in 3 to 5 years, and what will be the investor judgment on that EBITDA, how much of that can be achieved. Will it be expensive in 3 years if the company achieves those figures? And if a company does not achieve any earnings today, obviously you have to take another measure to express companies on revenue multiples as of today.
And then the alternative is the earnings multiple. Mm-hmm. So I guess that works pretty simple, but just with the earnings.
Yes, the earnings and the revenue, this is basically the top line and the bottom line of the profit and loss statement. With the revenue, the advantage is that the figure is pretty straight. You have very little room to manipulate the figure, and the sales figure is a sales figure no matter what accounting you apply. I mean, there's some differences in revenue recognition, obviously, but the room for discrepancies there in treatment is much less. Than the further you go down the profit and loss of a company, the further the results get subject to different accounting treatments, also temporary impacts, be that tax, currency, financing, whatever. And what we try to achieve is to have the figure also on a multiplier basis, which is most representative for the sustainable cash flow a company is generating. And therefore, in practice, often the EBITDA multiple is seen as the best cash proxy, and has most relevance in when applying multiple valuations also in practice. We often come across also among us, we talk about is it 6 times EBITDA? Is it 8 times? What do we see here? Yes, but EBITDA, this needs more reinvest. So we only see a smaller EBITDA multiple. What is it on EBIT? This is basically EBITDA, is the operating earnings before depreciation and amortization. So it looks at what can be generated before considering what part of that do we need to reinvest in the company.
Right.
So a company with more need for reinvestment, obviously the franc of EBITDA I earn is less worth than a company where I do not have to reinvest everything, because that's then goes straight to my pocket. Mm-hmm. So it's really always a balanced judgment you have to form on all levels of the multiples. With SMEs, for example, we usually take EBIT or EBITDA as most relevant figures. Earnings can be distorted, as mentioned, due to timing practices, non-operating elements. Revenue is too crude of a measure to really draw meaningful conclusions, because it just has a blind eye on the profitability of the company.
And actually, with both methods that we just discussed, you actually need a multiple. So how do you determine the right multiple?
Well, the multiple is coming out of the publicly quoted companies. As you mentioned before, the market capitalization. You have there an observable value for a company. That's the market value of the company, which is the equity value plus that and that the elements, which then forms the enterprise value. And you can observe that. You have databases, you can read those out. And you see also the revenues and the EBITDAs and the EBIT of those companies. And also you have forecasts from analysts, how they will develop or are supposed to develop in the future. And that gives you a data set. Let's say a company today is 8 times 2020 EBITDA, 7 times 2021, 6 times 2022. You see there the growth pattern underlying and how the market is valuing those companies. And then you can obviously form a peer group where you say, I look at companies being active in the same field, catering similar clients or comparable clients, facing the same circumstances. Obviously, if I have, it's always future looking. So if I expect my company to earn 100 in EBIT this year, 2021, I look at all the peer companies, they are called. They are on average traded with an 8 time, or they range from 6 to 12 times. Where would that company I look at be most sensibly lie in that range of the peer group? And then you can deduct for that company, for example, it's 7 times EBITDA, so 700 would be a reasonable figure.
Perfect. We also have another method, discounted cash flow, or DCF in short, as an additional method. Yep. How common is that and how do you use it?
That's usually the backbone. And when I say the backbone of the valuation is that I need to have for every valuation a meaningful view of the future financial development of a company. I have to think where that company will go in the next couple of years, and also bring that down to profit and loss figures, to balance sheet assumptions. So naturally, the discounted cash flows gives me the most accurate view if those plans materialize. And also when applying an EBITDA or a revenue multiple, I always apply them to future figures. Very little is of interest what happens in the past. Everybody's interested in what I'm going to earn in the future. So I have to have that set of figures anyhow. And the most accurate number I can come up with is the free cash flow, showing all those interdependencies, at least that I know of, and at least that I used some scrutiny and effort to come up with the most probable likely outcome. And if I have that, that gives me the fundamental value of the company. However, this method has a huge drawbacks because there are so many individual factors playing into that. None of them are usually mutually exclusive, so they're also interconnected and there are dependencies. And often people try then to reduce the overall complexity by adjusting one crude figures to arrive at a number they had in mind before they even started the exercise. So, and these are usually the cost of capital. And so for us, it's a very powerful tool with regards to what are possible future outcomes and what are the value conclusions of possible future outcomes, and then also cross-reference that with the market values. Because of the companies in an industry, if you have the right peer group, you can assume that the value drivers are comparable with the peer group companies and the DCF. So if you arrive at a result with the DCF that's way higher than with the peer group results, you have to ask yourselves, was I overly optimistic in my projections? Why am I developing better than everybody else? Do I have a blind eye on certain risks? Are there alternatives I do not take into account? Are there several elements missing? And there is a back and forth always between all the methodologies, also to reflect that on the current business plan and to make sure that, to the best of your efforts and knowledge, all information you have is reflected also in the DCF methodology. But we see in practice that it's often overly technically used. Just, I have a business plan, and then the question is, what's the WACC?
Right. Yeah.
And that cannot be judged without judging everything else. Because the business plan, you have to judge the risk with the business plan. We are not usually confronted in a situation where that capital as a pricing model, which is most commonly used to define that weighted average cost of capital, that assumes that every risk is fully diversifiable, and you look at every asset only from a portfolio basis. So if you acquire 100 companies, you can live with one not reaching its goals and probably also going belly up because you have 99 others which are making up for that. If you're going with an SME to the market, you're looking at a competitor, probably a business of same size, and they are looking at it and they cannot afford that this investment goes sour. So they have a different risk perception, and the question is who is the relevant, or what is the relevant market for the company, and how will that be reflected? And then it becomes pretty complex, and you have also then to factor in other elements to come up with sensible conclusions. But for the underlying financial analysis, which has to be done in any case with every methodology, that's why I also call it the backbone, because you should put enough diligence and effort in coming up with your vision for the company for the next 3 to 5 years. Does not have to be 10 years, and then put those into consistent and robust figures to start your valuation exercise in the first place.
And last but not least, there are two additional methods that we can choose from: the book value and also the liquidation value. Yep. Do they play any role in your valuation process?
Yes, they do. For example, with companies of limited future. If you look at a company which loses the basis of doing business, be that by a pandemic, right, be that by the owner just being so instrumental for the company that he cannot be replaced. That's especially the case for smaller companies. Mm-hmm. So if you look more at a bundle of assets rather than a continuing stream of earnings, then you look at book values. You can adjust those book values because when you try to make those book values into cash, for some, they will be not undervalued, and you will achieve a higher market price. For other ones, the market price will be lower, or there will be no market at all, and you just have to scrap it. So, if you talk of liquidation value, one has to be aware that a meaningful portion of businesses and business successions are de facto liquidations. So, also in cases where there is a huge substance, and that's often is also the case in the form of real estate, where you have a factory which was in a town located next to the main station 100 years ago, and now the industrial world has changed, all manufacturing and everything else, and then the ground it stands is just much too expensive to operate a business in. Then probably the value of the real estate is more than of the company, and then you have to decide what's the value of the company. Can I transfer it to a different place? Is that possible at all? Or the highest figures might be then the liquidation value.
And of course, you also wonder now, by understanding the different valuation methods that we have at hand, how can we positively or also negatively influence the value of our company?
Yeah, the value of the company is influenced by the business decisions that an entrepreneur makes. What we can do is, when we accompany them on a longer term basis, show them elements which can be done differently. For example, you use leasing, whereas you acquire assets, do financial engineering elements, also ask some questions if this is, from a financial point of view, really the best way to do stuff, be that with location. But other than that, the value is driven by the investment case. And you cannot, in the short term, change your investment case. You can stress out some elements which are critical from an investor's point of view, where he could work on. For example, with the compositions of customers, if you have a bulk risks on the customer side or on the supplier side, that would be negatively perceived by investors, and there can be small adjustments made. But other than coming up with, let's say, the documentation of the investment case, making everything transparent and put it in, also make it understandable for investors, it's difficult. You cannot just construe values ad hoc.
Right. And we also learned that it's quite a complex process to come up with the right company valuation. Do you use any tools along that process that make your life a bit easier?
Sure, we use tools. I think most important tools are databases. I think the calculation we do only at the end of every valuation project. Most important is to gather information about the industry, about the target, the trends, the investor sentiment to the industry. There are certain elements like, for example, a merger market or fact set, which give you those data points with regard to valuation of peer companies, or also past M&A transactions, how much has actually been paid for certain companies that allow you that. And beyond that, we obviously then draw on to research, sector-specific research, to form a judgment. What are the growth rates within the industry? What are the underlying drivers? Where is this company positioned? Whereas its competitors. When looking at companies, we usually start with the investment case and the old Porter's 5 forces. Where does it go? What are the different influences on the company, the substitutes, the clients, the suppliers, and to make a judgment on that. And only at the end you put that into figures, and usually you could do that on a piece of paper. I mean, we use Excel, but you could also do that with a pocket calculator or your iPhone. That's not overly complex.
But at the same time, you know, these external things, the market and everything else that you mentioned, they constantly change. So the question is also, how often should I actually do a company valuation? Is that something that I should repeat every year, or what's your take on this?
It depends on the purpose of the valuation. We have clients who do that on a regular basis as sort of strategic controlling, just to see how it develops, to form a judgment if they are on the right path. We have other clients, they do that for incentive plans and also employee participation schemes. For them, we do it usually on an annual to biannual basis. It is an exercise which requires some efforts and also implies certain costs. So it cannot be done on a weekly basis. This doesn't not make sense. And most of our work is event-driven, basically selling a company, buying a company. Even 1 year can be can be quite short for, let's say, stable businesses. But as we've seen in the past year, things can change rather quickly, and probably 1 year is way too long if for that use you need to have the figure now.
Right.
So, but in general, biannually is a sensible figure.
And purpose-driven, of course, yeah. And in what situations should I actually seek outside help? Because I probably can't do all the valuation process purely by myself and with my own team, right?
I mean, there I again want to stress that for me, valuation is always an advice. Mm-hmm. It's not... The main goal for me is not to come up with a figure which is pinpoint accurate to the fifth decimal. That's an illusion that's possible at all. And it's only my main goal is to reflect all investor considerations on a company and show the different points and angles of view that investors take at a company, and show the entrepreneur, if you look at that's seen as advantages, that's maybe seen as critical, and really sharpen his awareness of what's the outside perception of his company. Yeah. So I don't know if that answers the question, but I think it's more of a reflection. Me as an entrepreneur, I'm so invested in the business, and also myself. If I do something by heart, usually I have it right in front of my eyes, and our job is to take really 2-3 steps back and reflect everything we see with how you could look at it from the outside world, and with a focus on the financials and the investment case, and that can deliver very interesting input to an entrepreneur with regards to is that vision that I have, is that seen sound and viable from an outside view? Where are the pitfalls? What are the elements which are seen critical? Where do I have to work on some more to convince people of my case?
Right. And in that regard, how does UBS support startups in this matter? How can you help them?
Yep. With startups and valuation, I have to be quite honest that we do not go into the field of commercially valuing startup businesses, because as mentioned in the introduction, we are there solution-oriented. So if we advise startup companies, then it's event-driven. If they require some outside funds to develop the company, and it's more on a how do you build up the investment case, to whom present it, in what manner, what's the timing, whom to approach, what to tell, what's the message. And obviously you have some ideas of where the value levels might be, and what can be achieved, but this is very broad, and it's as mentioned, it's not the solution is not by making more calculations. The solution is that doing more of the right thing, and try to achieve the maximum, and then make a sound decision if I gonna enter in that transactions with that investor, which is the best investor that I could have under the current circumstances, and are making those figures sense, instead of coming up with the figures first and then trying to achieve that. Obviously, often the investor also requires some guidance, and there, just from process view, as mentioned before, and also me as an owner, I see the value always very high.
That's the natural bias that we have as founders or owners. Yeah. Exactly.
It's like my old children are always the most beautiful.
Absolutely. So now, thank you for sharing all these insights, Jürg. We want to sort of wrap up this episode with some rapid fire questions for you. So I either give you a choice or a short question you can answer in one sentence. Are you ready?
Sure.
What company would you like to have co-founded?
That's a company called Swift, which is active in the virtual bicycle training space.
Nice. And what's your favorite valuation method if you had to choose one?
At the end of the day, it has to be multiples, knowing that they are more complex than everything else when done right.
And where do you go to think?
It's on my bike.
Not surprisingly, after the first answer. And what's the best reason for performing a company valuation assessment from your perspective?
Either for an event or for a self-reflection to also get that outside view in and get an honest view out, an unbiased view from an outsider.
Nice. And the last question for you today, what advice would you give to your 20-year-old self?
Numbers as such are mostly meaningless if you don't have the context.
I like that a lot. Jürg, thank you so much for stopping by. All the best for the future and hopefully some happy more valuation processes along the way.
Thanks to you, Silvan. Very nice talking to you.